Hello and good afternoon. We are here with all the important topics right before the U.S. stock market rings the bell. Nvidia Corp. Co-founder Jensen Huang recently made his first visit to China in 4 years, amidst growing concerns over Beijing's ability to circumvent U.S. chip restrictions. During his low-profile tour, he visited Nvidia's offices in Shenzhen, Shanghai, and Beijing, engaging in cultural activities and possibly having informal meetings, though details were not disclosed. This visit comes at a time when Nvidia's AI accelerators are central in the technological competition between the US and China. Huang has expressed concerns that increased sanctions could lead Chinese firms like Huawei Technologies to develop their own AI chips, potentially challenging American tech dominance. Nvidia, whose market value significantly increased in 2023 due to its role in AI, has designed semiconductors for China complying with US sanctions. Huang's visit, highlighted by social media posts including one showing him giving away an Nvidia GeForce RTX 4080 graphics card, ended in China before he proceeded to Taiwan, marking his fourth visit there in less than a year. UBS Group AG's Global Wealth Management Division believes that the effects of the People's Bank of China's monetary easing are already reflected in the market, and stronger policies are necessary to revive China's equity market. Eva Li, who leads Greater China Equities at UBS Global Wealth Management, stresses the need for sustained and comprehensive strategies to address deep-seated issues in the Chinese economy. Despite prevailing challenges, UBS considers Chinese stocks as their preferred market, anticipating a return of around 10% this year. However, they view current measures like cuts to banks' reserves and policy rates as inadequate for significant market stimulation. UBS adopts a defensive approach to Chinese equities, focusing on state-owned banks with attractive dividends, sectors with consistent cash flow, and new economy firms that are actively repurchasing shares. The outlook for China's assets is worsening, influenced by a lengthy property slump, geopolitical uncertainties, and a lack of aggressive stimulus, leading to substantial losses in market value. Investors are now looking towards more significant fiscal actions and holistic reforms to propel growth beyond the current moderate expansion rate. Sony Group Corp. has terminated its planned merger with Z Entertainment Enterprises Limited, ending a 2-year negotiation and leaving Z exposed in a competitive market. The merger's cancellation, caused by a stalemate over leadership issues involving Z's CEO Punit Goenka amid a regulatory investigation, would have formed a $10 billion media titan to challenge global giants like Netflix and Amazon. This development follows after Sony's final decision, post a 30-day grace period, due to unresolved disagreements over Goenka's role, who is currently under scrutiny by India's capital markets regulator for alleged financial misconduct. The termination impacts Z significantly, whose profit plunged 95% in the last fiscal year and now faces intensified competition, particularly as rivals like Reliance Industries and Walt Disney Company advance their media consolidation in India. For Sony, this means rethinking its strategy for India's burgeoning media market, where it had hoped to leverage Z's extensive regional content and television network. The failed deal, nearly complete with regulatory approvals, had initially proposed a dominant stake for Sony and a smaller share for Goenka's family. This is all we have for you today. We are MEXEM TV, and we will be here next week, same place, same time. Goodbye.